Hi, I'm Chris Lewis. I'm the CEO of Hartshead Resources, and today I'm going to tell you a little about the company and the recent transformational deal that we've done with RockRose Energy regarding our production license in the UK North Sea. I'm going to share some slides with you and then take you through a description of our project, the macro environment, and the recent transaction. Just bear with me while I share my screen. And I'll move straight on to our executive summary slide. So in short, Hartshead has recently executed a farm-out transaction which transforms the company and positions us to take the next steps with our Phase 1 gas fields development project through project execution and to first gas. In summary, Hartshead farmed out 60% of its Southern North Sea license for a total consideration of $196 million for Phase 1 and $9 million for Phase 2. This $196 million is effectively the consideration paid by RockRose to acquire 60% of the Phase 1 project, and approximately $150 million of this is classified as Hartshead's equity contribution to the development project capex. Therefore, this transaction, alongside a recent capital raise, fulfills our anticipated equity capital requirement for our capital stack to progress with our development project. We're now working on putting in place a debt facility alongside this equity to meet the full capital requirement for our remaining 40% of the development. This means the company will be fully funded once the debt facility is in place to take a final investment decision on the Phase 1 301 BCF gas development project, execute the development plan, and move forwards towards gas production and cash flow. All this is happening in a highly attractive commodity market where gas prices are still over 2 times their historic averages and well above our internal gas price forecasts and significantly higher than the project break-even, which is around 30 pence a therm. The key milestone for the project will be the submission of the field development plan to the NSTA, scheduled for next month, and then following this, taking a final investment decision to execute the plan, scheduled for Q3 this year. Following on from Phase 1, there are multiple other opportunities on the license, bringing the total mid-case resource estimate in the block to be almost 800 BCF of gas. The company currently has a market cap of around $100 million, which you will see from the value of the farm out and the project is a significant discount to the implied valuation from our Phase 1 development project alone. Other important points to note is that the company is 17% owned by board and management, ensuring close alignment between shareholders and management as we move forward executing the project into becoming a cash-generating organisation. So now I'd like to briefly take a look at gas markets in the UK to provide a bit of context to the commodity prices that we've experienced and expect to see. What now underpins the gas price in the UK is the global LNG market. Cheap Russian gas is no longer available to Europe, and this has changed the availability of gas from European sources to the UK and made Europe and the UK increasingly reliant on LNG. We believe this provides a floor to prices significantly above historic averages and will provide a strong gas price market for Hartshead to sell its gas into. In addition, gas is a vital part of the UK energy mix. Gas still accounts for a large proportion of power gen in the UK and is still required to heat the vast majority of homes in Britain. In addition, domestic cooking and industrial uses are still significant, meaning that gas will remain an important part of the UK energy mix for several decades to come. I also want to take a quick look at our license and the projects in the North Sea. The yellow area, shown in the illustration, containing 5 offshore blocks, this constitutes our license P2607, which we have farmed out 60% of to RockRose. As mentioned, our Phase 1 development contains independently audited 2P reserves of 301 BCF of gas. It is this project that is now very mature in terms of development planning. The 2 fields that form our Phase 1 development will be developed through 6 horizontal multi-frac production wells and 2 normally unmanned gas production platforms. Gas produced at these platforms will be transported via a 40-kilometre, 12-inch pipeline to connect to Shell facilities at the Man Alpha platform, and then transported onto the Bacton gas terminal for final processing and delivery to a sales point onshore UK. Hartshead currently has a letter agreement with Shell detailing the key terms for Shell to transport and process Hartshead's gas, and we will be surveying our final pipeline route this summer in advance of moving into project execution later this year, when we will award contracts for platform construction, pipelines, and drilling. As previously mentioned, in addition to phase 1, we also have phases 2 and 3. Phase 2 is another development of 2 gas fields with contingent resources of 139 BCF of gas. Phase 3 is an exploration portfolio of a number of near-field exploration prospects that, in the case of success, can be rapidly monetized via our phase 1 and phase 2 infrastructure. The prospective resources associated with phase 3 are 344 BCF of gas. This takes the total resource in the license to almost 800 BCF of gas reserves and resources. So with that background, I'd like to move on to discussing the farm out in some detail. The transaction is nothing short of transformational for Hartshead. Prior to the farm out, Hartshead was 100% owner of a gas development project that was not funded. Following the farm out, we can demonstrate a very clear route to fully funding our remaining 40% share of the project and show that development is now completely funded, subject to a debt package being put in place. The transaction has taken the finance risks associated with the project completely off the table and clears the way for project execution and moving forward to first gas and cash flow. Retaining 40% in the project means that Hartshead have kept a material and meaningful stake in our phase 1 development. And to put this into some context, our remaining 120 BCF of gas is equivalent to approximately 20 million barrels of oil equivalent. At plateau production rates for the project of 140 million standard cubic feet a day, net to Hartshead would be around 56 million standard cubic feet a day of gas, which at £1 a therm would equate to revenues of approximately $30 million per month. This is significant value to Hartshead once we get into production following project execution. The consideration paid by RockRose to acquire at 60% also has significant real value to Hartshead. RockRose have effectively valued their 60% of the project at almost $200 million, which is the consideration in various forms that flow through to the Hartshead account. Despite the transaction structure, this can be considered Hartshead's value and should flow straight into the implied valuation of the company. RockRose spent 9 months evaluating and negotiating this deal, using their full technical and commercial team. To achieve this result for Hartshead is a clear valuation, not only of our development plan and our assets, but also our strategy to take existing discovered fields in the North Sea and approach these with new development concepts in order to create value from known resources. The transaction also commercially validates the phase 1 development. A consideration of 196 million for 60% has a clear read-through value for 100% of the project and a clear implied value for Hartshead's remaining 40% share. Taking this implied value of Hartshead's remaining 40% and the consideration of nearly $200 million, the implied value of Hartshead based on this transaction for phase 1 alone is over $300 million, about 326 million. This is over 3 times greater than the current market cap. As mentioned, this transaction, combined with a recent $20 million placing, should meet our equity component for our capital stack, the capex requirement for our 40% of the development project, alongside a debt facility which will be put in place prior to phase 1 FID. This means that Hartshead is fully funded for its share of the development cost. We are currently in discussions with various providers of project finance and confident this facility will be put in place in the coming months. The deal now perfectly positions the company to take FID on the project on schedule later this year. The key milestones that we reach as we move the project forward will be submission of the FDP, putting the debt package in place, and taking FID in Q3. So I'd like to quickly look at the transaction structure, just to give you a little bit more information on how the deal has been put together. So at completion, RockRose will make a cash payment of $12.2 million to Hartshead, and completion is only subject to approval by the NSTA of the transfer of license interest. That process is currently underway with the NSTA. Then, at FID, RockRose will provide a carry to Hartshead on the first $96 million of capex required for Hartshead's 40% of the development cost. So this money will be spent by RockRose on Hartshead's behalf and is considered Hartshead's equity contribution to the project. A cash bonus is also payable at FID, and this cash bonus will be used by Hartshead to directly fund the next part of the project capital requirement prior to the drawdown of any debt facility. The final part of the consideration is a retained energy profits tax benefit. The transaction was structured as a split between carry and cash considerations in order to share the EPL benefit, thus retaining some of the benefit to Hartshead. Had the transaction been just a carry with no cash element, the entire EPL benefit would have been to RockRose's account, with Hartshead receiving no benefit at all. It is these four components of the deal that make up the full consideration of $196 million for a 60% interest in the license. And the structure also meant that any potential capital gains tax from the transaction and the consideration paid by RockRose was absolutely minimized. And as I said, there's also a bonus to be paid on phase 2 once that project reaches FDP approval with the NSTA. So looking at how that really flows through into valuation for Hartshead, this transaction, the retained 40% in the project, has a clear value. And if we look at the valuation waterfall chart, we can see all the value elements that make up an implied value of Hartshead of around $600 million when taking into account the remaining net present value of our phase 1 development and our 40% interest in that. So looking through the waterfall, current cash and recent placement of $20 million clearly makes up over $20 million of value of cash at hand. Following this is the transaction consideration, and this can be shown as direct value to the company. There's the initial consideration, bonuses, the carry, and the tax benefits that make up over $200 million of value in Hartshead when taking into consideration phases 1 and 2. And finally, the independently audited valuation from ERC last year of our phase 1, 301 BCF of gas, gives an MPV for our remaining 40% of $380 million at 81 pence a therm gas prices. And taking all of the elements together, the implied valuation, therefore, for Hartshead is approximately $600 million, or 22 cents a share. And this is a significant premium of over 6 times the current share price. The cash in the bank and the consideration paid by RockRose alone equates to roughly 8 cents per share. And that's not even taking into consideration the remaining value of 40% of the entire license of phases 1, 2, and 3. So really delivering tangible, measurable, implied value to Hartshead across cash, transaction consideration, and remaining equity in a phase 1 project and license P2607 as a whole. So I just want to focus a little bit on the Energy Profits Levy, explain how this works and how important it is. The current fiscal regime in the UK provides a super deduction of 91.4 cents in the dollar for investments into oil and gas projects. This means that if you're in the UK oil and gas, if you're a UK oil and gas company with domestic production paying domestic taxes, $100 million of capex effectively costs you $8.6 million. The chart shows the impact this would have on a farm in E coming into our phase 1 development in similar terms to the transaction recently achieved by Hartshead. The farm in E costs shrink from around $300 million under the previous fiscal terms to less than $100 million under the new super-deduction. Taking into account funds deployed by the farm in E for their 60% equity stake, and also the funds they would deploy on Hartshead's behalf in respect of cash and carry elements. So clearly this acts as a huge incentive to invest in UK oil and gas projects. So now I want to look at Hartshead's valuation again and really what comes next. Hopefully now the implied value of Hartshead as a result of this transaction is clear. However, that's the beginning of the story, as the chart shows. As we move through the development project execution into first gas and then onto peak production, once all 6 wells are drilled, the industry value, so industry metrics, industry valuation for our project will increase from the value paid by RockRose of around $4 per barrel of oil equivalent up to potentially $25 per barrel of oil equivalent. So clearly, there's a lot of value still to be delivered during the coming months as the development project progresses through project execution, through first gas and onto plateau production. And this provides further opportunities for Hartshead to monetize its remaining position, if so desired, and return some of that value to shareholders. So now let's take a brief look at RockRose. Very quick overview, but fundamentally RockRose is an established UK oil and gas company. The team at RockRose have significant operational experience. The company currently has production of around 27,000 barrels of oil a day equivalent and reserves and resources around 80 million barrels of oil equivalent at January 2021. They have a significant position already in the Southern Gas Basin and understand the subsurface, infrastructure and commercial environments in the area that we're operating. So in short, RockRose is a technically, financially and operationally strong partner with balance sheet and revenues available to drive our phase 1 development project forward. As previously mentioned, we now have our anticipated equity funding in place for our phase 1 capex. This comprises existing cash, the recent placement and the RockRose consideration. The total capex associated with our remaining 40% of the project is around $280 million. This leaves Hartshead requiring a debt facility of around $100 million, which is less than 40% of the company's total phase 1 capex requirement. Having a credible partner, having our own significant equity contribution to the project, and having reduced our project interest makes the debt discussions we're having at the moment very straightforward. We currently have a number of discussions underway with providers of project finance on debt and prepay and anticipate finalising these discussions in the coming months. Once finalised, Hartshead will be fully funded for its phase 1 development and we will be able to move forward into project execution. Finalising the farm out is a tremendous milestone for the company and positions the business on a very strong footing to move forward. There are still key milestones coming up as discussed previously, the most important of which being the final investment decision to move into phase 1 development project execution. This then triggers the award of key contracts and the construction of platforms and pipeline infrastructure. Prior to FID, there are 2 key milestones that we anticipate reaching in the coming months. The first will be the submission of the field development plan to the NSTA and seeking their technical acceptance of that plan. The second will be the finalisation of putting in place a debt facility. Following FID, the project will be executed, leading to first gas and cash flows for the company in late 2024 or 2025. We're currently finalising our field development plan following engineering studies on platforms and wells, which will inform an updated project schedule. And alongside project execution, we also intend to finalise commercial discussions with Shell to develop operating agreements for the transportation and processing of our gas. We have a highly experienced team at Hartshead who are ideally placed to deliver the project to FID and beyond. Across all disciplines, we have highly experienced oil and gas professionals, in most cases with significant experience in the Southern Gas Basin. In addition, we have a highly experienced board with corporate, commercial, operational and technical competencies required to build and run organisations capable of combining the right assets, the right finance and the right personnel to deliver real value for shareholders. And I would just like to reiterate what a tremendous achievement this is for Hartshead to secure this farm out and funding for our development moving forward. The implied valuation from this deal, taking into account the current cash position, consideration paid by RockRose, and the value of our 40% interest in the project, is 22 cents a share. And the project is now significantly de-risked from a financing perspective. The company has never been in a stronger or better position to deliver real value for shareholders. Thank you for your time.